Welcome to another episode of Real Estate Investing Explained. Here's today's question. And so we've talked about note investing sort of abstractly here, and I'd love to dive into two examples of an actual note deal that you've done, if we could, one being good and one being bad. And I'd like to start with the good. What are the details of a good deal that you've done in the note investing space? How did it come together? And maybe what did the numbers look like?
So I did actually put together a couple, just short, quick ones that I could blow through. But I normally don't look at an individual note. We look at how a pool does. So what I did was I said, let me get a couple examples. So the first one is a junior lien where you typically exit through the borrower. And I'll show you what one of those looks like. And then I was going to show you a first mortgage that wasn't so well. And first mortgages, you're typically exiting through the property. So I'm going to show you, like you said, a good deal and a not so good deal. And then I was going to maybe even run through a quick small pool example. And that's really what we look at is in most cases. You would look at a deal or look at one house. We're really looking at a pool. And I'll show you what that kind of looks like. This was a junior lien in Milton, Massachusetts. And the original note was $76,500. And this was a second mortgage. And we paid $14,610 for that. And it was a 15-year loan. And the payment on it was just under $700 a month. It was $698.34. And the interest rate on it was 7.25%. And the payoff on this, because it was non-performing, was $84,594. So the payoff was actually higher than the original loan amount, right? Because they're delinquent. They were $12,570 in arrears. The fair market value of this property at the time was $450,000. And the first mortgage was $370,000. So you can see that's a second mortgage that wasn't completely covered with equity at this time, but they were current on their first mortgage. So in this particular case, the husband had gotten injured and he was unemployed for over a year. So what we did was, we do an outreach campaign. So sometimes the mail campaign, phone campaign, door knock service, all those types of things. But we got kind of lucky on this one. This is why it was pretty much a good deal, is because he called in right away after he had gotten contacted. And this guy wanted to stay. He had 2 children and, the homeowner was back to work as a police officer. And he was hoping to get his payment around $500 a month because that's what he felt was affordable. So a lot of this is an affordability play when you're doing a modification. And so what we did was we were able to extend the term to a 30-year amortization. We lowered the interest rate down to 6.5%. His wife actually put $5,000 from her retirement account towards the arrears. Remember I said it was like $12,000 and something in arrears? She was able to access, so you're allowed to access your retirement account penalty-free if you're in foreclosure. A lot of people don't know that, right? And then what we did was after we got it reperforming, we turned around and sold this note for $43,000. And you remember if we paid 14 something for it. So just a quick recap on this. We sold a note for 43. We had paid 14,610. The monthly payments we received, because we collected some, it was about $1,498 in payments. We received $5,000 in the arrears from her retirement, right? We didn't really have any legal fees on this one. And so our net income was $49,498. Well, we did this in 5 months. So what's the rate of return on that? It's actually off the charts. It's like 239%, right? So I hate to even say that because it's like so far off the reservation. You start to not be believable. So you get the idea how, that's a junior lien, that's a knock it out of the park. It wasn't highly contested. There wasn't a lot of legal fees, right? That's about as good as it gets, right? So then we have a first mortgage. This one was in Oakland, Tennessee. The original note was $85,000 and we paid $31,875. So the first thing you notice is when you buy a first, the cost goes up, right? It's not like buying a junior lien. Significantly more money to get into a deal. This was a 30-year mortgage, 360 months. Payment was $706.99. The interest rate was 9.375. The note payoff was $92,512. So they were $15,766 in arrears. Fair market value of this was $45,000, and there were back taxes of $1,501, and it was vacant. So what is the big red flag there? That the fair market value is only $45,000. So what had happened there was the original note was $85,000 and we paid $31,875. Well, did you ever hear of getting a bad broker price opinion or getting out to the property and finally getting inside it and realizing it's trash or whatever? So that can happen, right? So that's kind of what happened in this deal. We thought it was worth $85,000 or more. Turns out it's worth $45,000. So how did this shake out? So for us, after completing the foreclosure, we got a realtor to go by and do a BPO, broker price opinion. And then we got a contractor to bid a full renovation, and it came back at $19,000. And we decided that the best course of action was to renovate it and try to market it to like a first-time home buyer. And we were lucky. We received an offer 3 weeks after the renovation for $74,500. And it was a case where the buyer was purchasing it for his daughter. This deal, it wasn't as favorable as the first one, but this is how it shook out. So we had a total income of $74,500. The note cost was $31,875. We have to add in the renovation of $19,000. We had back taxes of $1,501. We had some legal, $2,196 in legal. We had some realtor fees from the sale, which was $3,725. So our net income was $16,203. And we did this one in 12 months. So our ROI on this, though, it was still 50.8%. So this was a tight deal, and the renovation kind of got us out of the tight deal, but it wasn't as sweet as like a junior lien, like in the first scenario. So this is a deal where we were exiting through the property. Now, do they all end up being super and they all end up being horrible? No, I mean, we have ones that, we make bidding on one today. It was pretty crazy. We paid, I think, $130 for it. The after repaired value was over $500,000 on the thing. I could probably sell it. I'm trying to sell it at the foreclosure sale for $310. So if I get a $310 on $130, that's knocking it out of the park right out of the gate. But they're not all like that. I mean, we just tend to win more than we lose. So that gives you a little bit of color on that. And I did a quick pool case study just to give people color. And this is on a junior lien pool that we had done last year, this past, 2019. We closed on like 700 assets at junior liens with an unpaid principal balance of $36 million on the pool. The loan to value was 51% and the combined loan to value was 73%. Let's keep in mind it's junior liens. And we do a normal, we do lien security check where we're checking with RealQuest, we're checking fair market values, we're checking with Universal Credit to do credit checks. We're going to Pacer, which is a bankruptcy scrub. We're doing our analytics, our proprietary stuff in-house. And then we're overlaying our cost, right? Whether it's the cost of capital, personnel, overhead, servicing, legal, all those things. Legal is probably our biggest expense next to cost of capital. So on this particular deal, pretty much the summary was our expected revenue was $7.327 million. We had about $790,000 in expenses. Our purchase cost was $4.778 million. And we were expecting the gross proceeds of $1.758 million, less the cost of capital, which is $556,000. So our net proceeds was just over $1.2 million. That's the kind of deals we're really looking at. We're really not looking at how does one asset do? It's really how did that portfolio do, if that makes sense in most of our cases.
And so is that mostly because of size? The individual assets are much smaller in scale. I mean, even though that was a home run deal, I mean, to make that material and grow a real business, you got to do a lot of those. Whereas with the pool, you could do 1, 2, 3 of those, and it starts to get pretty big in size.
Well, right. I mean, you could tell, okay, for these 700 junior liens was just under $5 million. We recently did a trade of, it was right around 30 million first mortgages, and it was only 145 loans. Big difference, right? So it takes a lot less personnel as well. Whereas those junior liens, that would take probably 2 asset managers to handle 700 junior liens, where it would only take, one asset manager can handle over 100 million of first mortgage to manage. So big difference in numbers.
That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.